We're on the brink of economic collapse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we're seeing an outright crash in consumer demand, and we're going to show you what is the leading indicator, what is driving this collapse, and how it's going to affect the manufacturing sector. We've been making the case over the last several shows that the decline in the regional Fed surveys is a real effect, and you're going to see, despite the fact that the headline government data, as you'll note today, suggests the opposite is actually happening. And we'll also make the case of why all this means that stocks are coming down, interest rates are coming down, and employment is headed higher as economic trouble is on the horizon. Let's over to Zero Hedge, where we picked today's story up with a whole headline: Home Depot plunges after the worst revenue miss in 20 years, slashes their guidance, is now blaming weather, lumber, but more importantly, what they should be blaming is faltering consumer demand. Now, we can look back to the pandemic. We can see Home Depot was a huge beneficiary of all the stimulus money. As people started working from home, they started upgrading their home, doing a lot of things, and that meant big demand for the home improvement company. Now, all of a sudden, we're seeing an outright collapse in demand, suggesting, as we note, that they had an earnings miss that's worse in a matter of 2 decades. Let's dig deeper into this to see if we can find out what's going on. Home Depot reported its biggest revenue miss in more than 20 years and slashed its outlook for the year as consumers delay large projects and buy fewer big-ticket items like patio sets and grills. In the latest sign, consumers have maxed out their credit cards after splurging on all kinds of things during the pandemic. Now, this is something we kind of mentioned before, is you typically see a big demand and usage of credit cards before they kind of get maxed out heading into a recession. So we're seeing some signs of that now, suggesting that Home Depot is now giving us a leading indication that consumers are indeed far worse shape than we thought. Here from the earnings report, after a 3-year period of unprecedented growth in our sector, thanks of course to a lot of fiscal stimulus, which we grew sales by over $47 billion, we thought 2023 would be a year of moderation, but our sales for this quarter were far below expectations, primarily driven by a lumber deflation and unfavorable weather. So let's talk about lumber deflation. That means prices of lumber went down. So what does that mean? What they're saying is, well, we didn't make as much money, but if prices go down, shouldn't, of course, demand go up? So what we're seeing here is prices are falling. Validating it's not an issue of prices keeping consumers back. It's a whole host of other things, perhaps like job losses. And now we're seeing lower lumber prices not leading to higher demand and higher sales. And of course, this goes on to say, as shoppers boosted retail sales in April, we're now reversing 2 months of decline. So now we're going to shift from Home Depot into the broad retail sales report from today and look at this from the government. A measure of spending in stores, online, and in restaurants rose a seasonally adjusted 0.4% last month compared with March, up from a revised 0.7% decline in March. So kind of what we're seeing here is Home Depot is sounding the alarms. Of course, the government report's giving us a little bit different picture here. We kind of know which one's going to be more accurate. It's more likely that we'll see Home Depot sales data kind of filter across the industry and other industries and show up in future government reports. But let's dig deeper here to see what's going on. Consumers spent more at auto dealerships, home improvement stores, bars, and restaurants online. They cut spending at gasoline stations and stores selling sporting goods, musical instruments, and books. Retail sales increased 1.6% in April. We should say slowed to 1.6% in April from a year earlier. The year-over-year increase was below the 4.9% inflation rate for the same period, suggesting kind of we already know that, of course, retail sales are actually not keeping up with inflation. That means demand is declining. Let's take a look at the retail sales in chart form, because I want you to see what we're experiencing right now usually leads into slowdowns. Now remember, 2018, 2019, we almost had a global recession. Here we see the global financial crisis. Here you can see the dot-com bubble. So a slowdown in retail sales is a broad indicator that something is wrong with the health of the consumer. And as it just said, they're not adjusted for inflation, and they don't reflect price differences as well as purchase amounts. But here's what we can do. We can adjust it for inflation. Now, I know this is a little bit of a chart crime, but we're doing the best we have with the data available by taking retail sales and subtracting off the consumer price index. And what we can see here is adjusted for inflation. When you go into recession, it starts to go negative, meaning prices are exceeding demand. And that's what you're seeing here is prices are too high there, and that means prices are rising faster than sales. Of course, that indicates demand is going down. That's not what you want to see when you hear people talk about a second half rebound or the Fed say effectively a soft landing or no landing. What we should be seeing here is demand saying, hey, you know what? Prices are slowing down. We're like that. We can afford that, and we're going to keep driving consumption. No. What we see instead is, of course, this relationship goes negative going into recessions. You see here just briefly went negative almost again. It had almost that crisis or that global recession late 2018, 2019. What happened? The Fed cut rates. Here you see the pandemic. Here you see it now. So we know for a fact demand is falling, but now we know that the Wall Street Journal says America's spending is trending more toward bargains and away from discretionary items. Yeah, the slowdown in retail spending reflects a slowing economy and still high inflation. We're seeing a more cautious consumer. Well, it's pretty obvious why we're seeing more cautious consumer, because wages aren't keeping up with inflation. That is a huge problem at all. Completely. So what we can note here is that when we look at the data, what we're seeing again is wages are not keeping up. It makes perfect sense. We see maxed out credit cards starting to show up. That means discretionary spending goes down. But one thing consumers do like a bargain is on their stocks. And of course, you can get a bargain on CTA-Timer Pro. It's $30 a month before it goes to 40. Made a mention to our subscribers that, hey, if we see one of these fast algorithms heading down, put that on your watch list, looking for opportunity. And you still have a 30-day money back guarantee. So if you like it or you try it, you don't like it, let us know. So try it out, risk-free. And now let's look at average hourly earnings, total private against consumer price index. And here we can see when this is negative below the horizontal black line, what it tells us is that wages are falling below the rate of inflation. You see it leading into, of course, the recession in 1991. You see it leading into the dot-com bubble. You see it kind of just ahead of the global financial crisis. You see we almost had a double dip recession. There's the evidence. You see it going into that 2018, 2019 global slowdown, and you see it now. Again, it's all telling us what we already know is the consumer is tapped out. But what is there another way we can look and see this trend? Well, let's go back to the University of Michigan on the Friday report. What did we see in the preliminary consumer confidence data? It outright crashed down. We see current conditions fell. We see sentiment fell. We saw future expectations fell. And these are big numbers, 9.1%, 5.4, 11.7, month over month changes, a big decline. But how does this translate back? Well, if you look at the stock market against the University of Michigan data, it is a great leading indicator. Now, the stock market can try to push sentiment higher, but if sentiment continues to fall like we're seeing now, and this does not show the preliminary data, it gets a rising market. Well, it tells us the stocks are likely to head down, not up on a year-over-year rate of change. How about when we look at retail sales against the stock market? Well, we do have some indicators where I've circled here in yellow where you can see stocks rising on a year-over-year rate of change as retail sales fall. But what happens is retail sales continue to fall, meaning if rising market doesn't incite demand, doesn't get people to go out and buy, and we still see a decline in retail sales, what this suggests, we'll go back to the chart here, means the stocks are likely to head down. We can see the market often front running retail sales only to find out, no, it didn't happen. And next thing you know, stocks come tumbling down. Here we can see a rising market is not spurring sales, telling us that something serious is indeed wrong with the economy. And what does that mean for interest rates? Well, if we look at inflation expectations, we see them coming down. We see a great relationship between inflation expectations of the consumer and broad interest rates. And what do we know? That the market still believes that rates need to go higher here, and that seems to be the prevailing view. But when you start to look at it from a retail sales perspective, if you're trying to get rid of inventory, what do you want, higher rates or lower rates? Well, the answer is simple. You want low rates because right now higher rates are not causing any increased demand, arguably is causing demand to go down. Here you can see, of course, when retail sales slow and come down in red, this is a 10-year treasury yield, it tends to fall. You can see there's periods where the market will drive yields up and then they come crashing down because obviously the market hasn't figured out that the economy is indeed in pretty bad shape. And what that means, of course, for retail sales, and we look at then initial unemployment claims as retail sales decline. Well, you don't need as many employees to not only because new orders are collapsing, but factory data starts to fall, as we'll look at it a little bit. You don't need as many people to work the store because you just don't have that many customers. And next thing you know, what do you see? 4-week moving average of initial claims rising as retail sales fall. It validates that this move down in retail sales should continue the trend of rising initial unemployment claims. Of course, on Thursday, we'll cover that as we normally do, but it all just suggests that economic trouble is on the horizon. The second half rebound that everyone's hoping for, that the market's kind of betting on, is not there. You can make the case now of why stocks are coming down, why interest rates are coming down, and why unemployment rates going up. What does that mean for the factory sector? Well, the government says it looks pretty good, which is pretty interesting given just the other day we talked about how those regional Fed surveys are showing really bad data for the factory. But check this out. The government says not so quick. Production at U.S. manufacturers rebounds after the March slump. What we can see is output rose 1% last month after downward revisions to the 2 prior months. And what did we see? This included mining, utilities, and total industrial production all increased. Manufacturing up 1%, industrial up 0.5%. The gain in factory output reflected a 9.3% jump in motor vehicle production. Now, what I'm wondering here is, for those of you in that industry, is this because we got a whole bunch of chips in and we could finish some cars? Is there demand there? What's going on? Weigh in the comments. Let me know, what are you seeing on the ground? Because what we can see is motor vehicle production way up, as well as primary metals, computers, and electronic products, along with chemicals. And this gain in auto production was the largest, if you can believe this, since October 2021, as vehicle assemblies totaled an annualized 11.4 million last month, the strongest, kind of going against the retail sales data, against Home Depot, strongest since July of 2020. But despite the fact that advanced in factory output, survey data, as we've talked about recently, shows the sector isn't doing it well. The Institute for Supply Management's factory gauge has indicated contraction for the 6 straight months, and business equipment orders have fallen in back-to-back months. Looking ahead, the picture is mixed. A gauge of the New York State manufacturing activity slumped in May, and by the most in 3 years, according to data from earlier this month. But factories were generally more optimistic. We'll see for how long, because there's a wonderful relationship between the stock market as well and industrial production. Here you can see this. Perhaps this is why they're getting excited, because on a year-over-year rate of change, the market's rallying. That in the past suggests you could see a turnaround in the economy, an increase in production, except when you go back and there's some isolated cases, and I didn't mark them all, but you can see the market started to rally up here. Industrial production continued to crash, and next thing you know, market turns around. You see the same thing here back kind of in the late 80s, and then it came crumbling down again. So as long as we can say the consumer is telling us, look, bad things are coming for the economy, we're spending less money, retail sales go down, unemployment rate goes up, you don't need your factory running at full steam, and you don't need as many employees, suggesting, as I made the case in the beginning of the show, stocks are coming down, rates are coming down, and unfortunately, unemployment's going up, as we're facing now a massive second half recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.